Welcome to the deep dive. So if you thought you knew the name Avantis, maybe think again. We've got a bit of a case of financial mistaken identity on our hands today. We're dealing with two entities that, well, they couldn't be more different, yet they share the exact same name.
It really is a study in contrasts, isn't it? On one side, you've got this explosive, high-leverage crypto project, massive short-term momentum, volatile derivatives trading.
Okay.
And then on the other side, a really rigorously structured asset manager. They specialize in low-fee, factor-based ETFs, all built on, well, decades of academic research.
Right. So our mission today is to clearly distinguish between Avantis, the AVNT DeFi token, and Avantis Investors, the folks behind ETFs like AVGE and AVDE. For you, the listener, this is really a deep dive into two fundamentally different strategies for generating returns. And maybe more importantly, the unique, often kind of ignored risks in both. We've pulled together everything from, market volatility data to some pretty deep academic critiques.
Ready to jump in. Because honestly, the two stories, they just couldn't start further apart.
Absolutely. Let's start with the more explosive side, the crypto token, AVNT. Right now, if you check the data, it's trading around, $1.87? And this isn't just a good day. This is a huge one-day gain. Over 76%. It's ranked like hashtag 129 right now, riding this massive wave of momentum.
And it's less a wave and more like a tidal surge of volume. I mean, following its listing on Binance, we saw that kind of crazy activity that, briefly pushed the price to $1.54 initially. Even right now, the current 24-hour volume is getting close to an astonishing $3 billion. The fully diluted valuation, the FDV, is hovering around $1.87 billion. So the short-term story is definitely strong, partly fueled by some aggressive trading over on South Korean exchanges.
Okay, but hang on. Anytime you see a move that extreme, you've got to question the foundation, right? What's the actual utility here? What's driving this massive price surge? Or is it just hype?
Well, technically, the platform itself is positioned to potentially capture future institutional flows. Avantis is the largest RWA perpetuals DX on the base chain.
Okay, let's break that down a bit. RWA, real-world assets.
Exactly. So they're trading derivatives on things like foreign exchange, commodities, major indices, equities, tangible stuff, not just other cryptos. And DX just means decentralized exchange, no central middleman.
Got it. So they're trying to bridge traditional derivatives with DeFi efficiency.
Precisely. And their big hook is something they call zero-fee perpetual trading, or ZFP. Basically, traders only cough up fees if they actually turn a profit.
Interesting.
Yeah. And that structure, plus a pretty serious team pedigree founders from places like Pantera Capital and Lazard, it backs their ambitious long-term view. The team is suggesting AVNT could potentially hit $12 by 2030.
$12? What?
But that's a big if, right? It assumes massive growth in derivatives and critically mainstream institutional adoption.
A 76% single-day gain is just, it's wild. Forget long-term investing for a second. That feels like pure speculation. Given that kind of volatility and the sheer volume, what are the warning signs? What are the technicals saying?
Yeah, the technical indicators are definitely flashing bright red. The relative strength index, the RSI, it's signaling severe overextension. It's sitting at 85.42 right now.
And just to remind everyone, anything over 70 on the RSI usually means overbought, right? Potential correction coming.
Exactly. So 85 is really up there. It suggests the current price isn't properly discounting the execution risks involved.
Okay, that's the short-term technical picture. What about the longer-term structure? You mentioned tokenomics earlier. Are there risks hiding there?
That's probably the deeper concern, yeah. Our sources point to a pretty significant tokenomics risk. Get this, 50.1%, just over half of the total 1 billion supply is allocated to community incentives.
Half the supply, just sitting there.
Pretty much waiting in the wings, yeah. Now, strong momentum and good staking returns might absorb that supply over time, but the worry is, what happens if the hype fades or those returns disappoint?
So that 50.1% for the community isn't just like a feel-good thing. It's a potential avalanche of sell pressure waiting to happen.
That's the risk. It represents a massive potential future supply dump. If staking rewards aren't great, especially after the first big unlock period, which is post-November 8, 2025, those early airdrop folks could easily trigger huge selling.
Okay.
Plus, remember, this initial explosive growth, well, there were allegations of civil attacks tied to the airdrop, people creating tons of fake accounts to grab more tokens.
All right, I remember reading about that.
So sustaining that daily volume above, say, $2 billion is absolutely critical to soak up all this potential selling and avoid a really brutal post-hype crash.
That certainly puts that $12 target for 2030 into perspective. It hinges entirely on keeping up almost superhuman trading volume, year after year.
All right, let's just take a deep breath now and step completely out of that high-octane crypto world. We are pivoting 180 degrees. We're moving into the much, much quieter and arguably slower world of Avantis Investors. Yeah, it's like entering a completely different universe, isn't it? Now we're talking about the traditional finance entity, the asset manager offering these low-fee ETFs, things like the Avantis All Equity Markets ETF, AVGE, which is trading around $83, or their International Equity One AVDE around $78.
And their pitch is basically value-added solutions, low fees, kind of mixing indexing benefits like diversification with daily active oversight.
That's the idea. And what they're doing is factor investing. Maybe we should explain that a bit. How does this academic approach actually differ from just, buying a regular S&P 500 index fund?
Good idea. Lay it out for us.
Well, it's different because they're not just passively buying stocks based on size, market cap. Factor investing, sometimes people call it smart beta. It systematically targets specific characteristics in stocks, traits that decades of academic research suggests might lead to higher expected returns over the long haul.
Okay, so characteristics like value, momentum.
Exactly. Value, momentum, size, small companies versus large. Quality, like high profitability and sometimes low beta or low volatility.
So instead of just buying the biggest companies, they're actively looking for, say, the cheapest ones or the most profitable or the ones trending up strongly, based on this academic theory that these factors predict better long-term results.
That's the core idea. Their underlying philosophy is that expected returns are basically a function of three things: the stock's current price, its book equity, and its expected future profits. So the portfolio managers use these quantitative models to systematically tilt or overweight the portfolio towards securities that score higher on those characteristics.
And does it work? Do we have any performance data?
Well, for context, one of their main funds, the Avantis All Equity Markets ETF, AVGE, it posted a year-to-date total return of 13.62% as of August 31st, 2025, according to one source. So it's a very structured, data-driven method.
That sounds so calm and rational compared to the crypto side we just talked about. Almost, boringly sensible. But our sources really highlighted that even this academically sound approach carries massive, often ignored risks. Let's unpack these ignored risks in factor investing.
Yeah, this is where the research gets, frankly, quite sobering. The risks involved in factor investing, they're not just understated sometimes. They're often fundamentally misunderstood by the very models used to sell them.
How so?
Well, first off, factor returns do not follow a nice, predictable, normal distribution. They deviate substantially. This means the actual risk profile looks nothing like those neat bell curves you see in finance textbooks. The tails are much fatter.
Can you give us an example? How extreme can that deviation be in the real world?
Okay, look at the momentum factor. It's one of the core factors Avantis and others use. During the market crash in April 2009, the momentum strategy had a realized loss of negative 36%.
Minus 36%. Ouch.
Right. But if you had calculated the expected loss using a standard model, assuming returns were normally distributed, which is what many risk models still do, the expected loss would have only been around minus 8%.
Whoa, that's not just a little off. That's a massive difference. Over 4 times worse than the model predicted. Shouldn't managers like Avantis be forced to stress test using that kind of realized catastrophic data, not just the theoretical normal curve?
That is an absolutely critical question people are asking. The critique is essentially that many sophisticated models, they look great on paper, but they fail precisely when you need them most during a crisis. And the pain doesn't stop there. It gets compounded by something called serial correlation.
Serial correlation. Explain that like we're just chatting over coffee.
Okay. It basically means that when a factor performs poorly, it's often not just a one-off bad month or quarter that quickly bounces back. Unfortunately, poor factor performance tends to be followed by, more poor performance.
Bad times cluster together.
Exactly. It tends to keep being bad right after it's been bad. And that makes the drawdowns, the periods of loss, feel, as one source put it, excruciatingly painful for investors who are trying to stick with the strategy for the long term.
And when you say long term, you mean potentially really long term, right?
Yeah.
Our sources had some alarming figures about how long people might have to wait.
The data is pretty stark, yeah.
Yeah.
Looking back over 55 years, individual factors can experience worse drawdowns of around 25%, which is bad enough. But maybe more critically, investors holding these single factors might spend around 20 years below the previous high point.
20 years.
20.
That's the length of a mortgage for some people. You're saying you could buy into this supposedly superior, academically optimized strategy today, and 2 decades later, you might still be underwater compared to its previous peak. That just changes the entire risk conversation for anyone considering these funds.
It absolutely does, and it really speaks to the level of patience required, which we'll come back to. And on top of that, the promise of diversification, mixing multiple factors together to smooth the ride, often breaks down exactly when you need it most.
How does that happen? I thought diversification was the one free lunch in finance.
Well, the simulations look good. A simulated 6-factor portfolio might show a worse drawdown of, say, 13.2% in the US, but the realized actual worst drawdown for that same portfolio was closer to 18.7%.
Why does it fail in reality during a crisis?
Because correlations aren't stable, they change. During normal times, the factors might act somewhat independently, giving you those nice diversification benefits on paper. But when a major crisis hits, think 2008, suddenly the correlation between all these different factors can shoot up towards one.
Meaning they all move down together.
Precisely. They all tank at the same time, completely destroying the diversification benefit you thought you had right when you need it most.
And beyond these performance issues, there are even existential questions about some of the core factors themselves, right? Maybe some of these academic ideas are just broken now.
That's the big debate in academic finance. The value factor, for instance, buying cheap stocks, it's gone through 2 brutal 11-year-long bear markets recently. That makes people wonder, has the insight just been arbitraged away? Does everyone know about it now so it doesn't work anymore? Yeah.
And momentum.
Momentum is powerful, but it requires a lot of trading, high turnover. That means trading costs can eat up a huge chunk of any extra return, the alpha. And incredibly, one source noted that since 1999, momentum has actually lost more in its crashes than it managed to earn during its good times, its bull markets.
Wow. Loses more than it gains over that period.
In net terms, yeah, because the crashes were so severe. And then there's the size factor, the idea that small companies outperform large ones. The empirical evidence for a reliable long-run premium there is actually pretty weak when you dig into it.
So, it seems like whether you're dealing with the short-term existential risk of a crypto crash after a huge pump or the decades-long potential risk of these academic factor strategies just not working as advertised, there's profound risk exposure everywhere.
Okay, now let's zoom in a bit on the factor investing space itself. There's this interesting dynamic because Avantis Investors was actually founded by people who used to work at Dimensional Fund Advisors, DFA. And DFA are kind of seen as the pioneers of applying academic factor investing. How do these two compare? Especially in that small cap value or SCV space, which is key for both Avantis's AVUV ETF.
Yeah, it's a fascinating comparison because the core philosophy, the engine driving them, is actually very similar. Both firms use what they call an integrated expected returns framework.
Integrated meaning?
Meaning they look at size, price to book, which is a measure of value, and profitability all together in a combined way. They don't just, say, screen for cheap stocks and then ignore profitability or vice versa. They weigh all the factors simultaneously. Okay, so if the basic engine is similar, where do the differences creep in? How do they execute differently?
It really comes down to portfolio construction choices and maybe a subtle difference in focus. DFA's approach has traditionally been designed to be extremely style pure.
Style pure.
Meaning they try really hard to minimize any drift. They want their value fund to only hold deep value stocks, their small cap fund to only hold small caps, sticking very closely to those strict academic definitions, those style boxes.
Okay, yeah, very disciplined. And Avantis?
Avantis seems to be a bit more flexible. Their main goal appears to be maximizing the total expected return based on all the factors combined. And this flexibility lets them include, for example, highly profitable small cap stocks. Even if those stocks aren't super cheap in the traditional deep value sense, they might not have the absolute lowest price to book ratios.
So that could lead to a slightly different portfolio structure.
Yeah, some analysts describe the Avantis structure as potentially a bit barbell-y sometimes. It might blend slightly cheaper stocks with these highly profitable, maybe slightly less cheap stocks, because the combination offers the highest expected return according to their model.
And we can actually see this in the factor loadings, right? The sources mentioned HML and RMW. Can you quickly break those down again and what they tell us?
Sure. HML stands for high minus low book to market. It's the academic way of measuring the loading on the value factor, basically. How much exposure the fund has to cheap stocks.
Got it. And RMW?
RMW is robust minus weak profitability. That measures the loading on the profitability factor, how much exposure it has to highly profitable companies.
So comparing Avantis and DFA using those measures, what do we see?
Generally, Avantis funds tend to show higher RMW loadings, more exposure to profitability, but slightly lower HML loadings, a bit less exposure to deep value compared to their DFA counterparts.
And that difference comes from how they build the portfolio.
Exactly. It reflects that flexibility. Avantis uses a composite score that blends price to book and profitability to weight stocks, prioritizing the highest combined expected return. DFA, at least historically, tended to do it more sequentially. First, sort stocks based on price to book value, and then sort within those groups based on profitability.
So for you, the listener, the takeaway seems to be both firms are very highly regarded. Both use sophisticated academic factor data. The choice between them might just come down to personal preference. Do you prefer that strict style purity from DFA, or the potentially slightly higher expected return focus with more flexibility from Avantis, which might lean a bit more towards quality alongside value?
That sums it up pretty well. No clear winner, just different approaches to implementing similar ideas.
Okay, so this deep dive has really shown us two completely different financial worlds hiding behind the same name, Avantis. One is chasing, exponential growth fueled by high-frequency trading, derivatives, crypto exchange listings. Think AVNT.
Yeah, pure momentum and leverage, really.
And the other is quietly seeking long-term alpha, extra returns, through these highly disciplined academic factor tilts in their ETFs, like AVGE or AVUV.
Right. And in both of these worlds, whether you're looking at a $12 price target for a token or forecasting long-term extra returns from factors, those projections rely heavily on models, on execution, and maybe most importantly, on investor behavior.
How so?
Well, you're either dealing with the psychology of, short-term retail frenzy and potential crashes in crypto, or you're facing potentially decades of that slow, grinding, painful underperformance that academically driven factor strategies can deliver.
Which brings us to our final thought. We've seen from the sources that even these structured, academically backed factor strategies can and frequently do result in years, maybe even decades of underperformance compared to just a simple market index. We've heard that figure, potentially 20 years below a previous peak. So here's the provocative question for you to mull over. What are the real chances that any investor, retail or even institutional, when faced with such profound, sustained periods of relative pain, watching the market roar ahead while their smart strategy lags for years, can actually maintain the required patience and discipline to stick with it long enough to potentially achieve those projected long-term returns?
Yeah. Can anyone really stay the course through that kind of tracking error?
That's something for you to think about.